The housing boom, fueled by the Federal Reserve and its record low mortgage rates, is about to experience a dramatic slump as the new relief bill has finally passed. This means more money is about to be unleashed into the economy, which could lead to a sudden inflation spike as business activity starts to be resumed later this year. Bond traders are fearing the Fed might be forced to hike rates even more aggressively and earlier than expected, which has resulted in last week's latest Treasury and mortgage bond rout. Additionally, due to low inventories, mass migration to rural areas, and the expansion of remote work, housing prices all across the country have surged at the fastest pace since 2014, but wages haven't kept up with that growth, and all of these determinants are affecting people's ability to buy new homes. The price bubble has become so unsustainable that demand is already significantly collapsing, and further increases in interest rates could push the entire market to the brink of collapse just as well. That's what we're going to analyze today, so stay with us. Don't forget to leave a thumbs up and share this video, and please subscribe to our channel to keep updated with our latest notifications. Last week, mortgage interest rates have unexpectedly soared, throwing cold water on already cooling demand. Consequently, the total mortgage application rate has flatlined, increasing by just 0.5%, according to the Mortgage Bankers Association's seasonally adjust index. The median contract interest rate for 30-year fixed-rate mortgages with conforming loan balances registered a significant hike, having increased to 3.23% from 3.08%. Mortgage rates jumped last week on market expectations of stronger economic growth and higher inflation, explained Joel Kahn, MBA's Associate Vice President of Economic and Industry Forecasting. The 30-year fixed rate experienced its largest single-week increase in almost a year, reaching the highest level since July 2020. On the same note, Louis Sarg, a senior loan officer at Freedom Mortgage, revealed in an interview the sudden jump in mortgage rates has caught him completely off guard. He had forecasted the 30-year fixed loan rate to stay at January levels of approximately 2.65% during the first half of 2021. However, the sudden increase has caused his refinancing pipeline to start drying up. That's why Sarg alerted that if the 30-year fixed loan rate oscillates above 3% for much longer, there would be more potential for further upside in rates. The latest housing rally has been fueled by several different factors. In addition to historically low mortgage rates, there was an unprecedented demand for suburban homes as city dwellers fled urban centers to escape the harsh effects of the health crisis and mounting social turbulence. But low inventory has sent prices to sky highs and formed the splendid price bubble that never ceased to grow. Rising borrowing costs could therefore not only jeopardize the rally, but also burst the housing price bubble and push the entire market to a secular correction. As inventory remains low, the chief financial analyst at bankrate.com, Greg McBride, pointed out that for the time being, a rising rate environment would downshift the market from red hot to merely sizzling. Higher rates are also bad news for lenders who have managed to collect huge gains ever since we entered a low-rate environment at the beginning of the recession last year. The latest mortgage application collapse marked a 9-month low, and pending home sales declined to 6-month lows. When combined with demand-fueled rising home prices and low inventory, these rising rates limit how competitive a potential home buyer can be and how much house they can purchase, outlined Sam Cater, chief economist at Freddie Mac. The rout in Treasury and mortgage-backed bonds has become even more noticeable this week. In a recent article, Bloomberg described that as Treasury yields, which strongly influence home loan rates, suddenly rise sharply, many Americans lose interest in refinancing their old mortgages. A reduced stream of refinancing means mortgage bond investors are left waiting for longer to collect payments on their investments. The longer the wait, the more financial pain they feel as they watch market rates climb higher without being able to take advantage of them. When markets are confronted with rising interest rates, asset and bondholders have to reduce the risk of future losses, and to do so, they typically dump risky investments. On the stock market, we know this phenomenon as a sell-off, which oftentimes can trigger a crash or correction in stock prices. The same logic applies to the housing market in an event known as convexity hedging, which means that investors who hold mortgage-backed securities seek risk reduction on their books to combat the damaging effects of slower loan prepayments. Now, over the past couple of weeks, the spread for Fannie Mae's 30-year current coupon has exploded compared to the 5-10-year spread, now around 0.8635, as the U.S. 10-year Treasury yield rose above 1.5%. The key driver to this blowout was the growing uncertainty amongst both investors and bondholders in face of the rising rates. Those developments outline that the Fed's attempt to offset the devastating impact the health crisis caused to the economy by lowering rates and pumping trillions of dollars into the markets in order to create an artificial wealth effect has not only enabled the formation of a massive bubble, as it could suddenly pop it due to the unsustainability of its policies. That's why investors and bondholders are already running for the exits, not to see their gains irreversibly wiped out in face of an imminent crash. Moreover, in the process of artificially fueling the bubble, policymakers have ended up worsening wealth inequality and housing affordability issues. As mortgage rates continue to climb, home prices are bound to keep surging, and home buyers will face more strains to find affordable housing as home builders are struggling to meet demand and potential sellers start to pull back. The spring housing market is on track to become the leanest, most expensive, and most competitive ever. Due to the recent ice storm, an acute drop in new listings was recorded over the past few weeks, which will make it even harder for buyers to find their dream home at the perfect price. The recent pullback resulted in nearly 207,000 fewer homes newly listed for sale compared with the same period over the last 4 years. To catch up with the ever-growing demand, new listings would have to expand by 25% annually in March and April, which is highly unlikely. As the supply gets tighter and tighter, home prices soar even higher, and increasingly fewer Americans can afford to have a home of their own. In January alone, prices increased more than 10% year over year, according to CoreLogic. But wages are not keeping up with the rising costs of housing. According to a 2020 report from the National Low-Income Housing Coalition, workers need to make $21.10 an hour just to afford a market-rate 2-bedroom rental. In some states, such as Arizona, that wage amount increases to $22.56. Conversely, the report found that the average hourly wage did not reach $21.10 for over 900,000 jobs in Arizona, including retail workers, office workers, and customer service representatives. By analyzing historical data, researchers found that it could take years before wages catch up. A 2020 City of Phoenix housing report has shown that between 2010 and 2018, the average home price in the city surged by 57%. Rental prices rose by 28%, but wages only grew by 10%. As a result, the slower growth of wages, combined with overwhelming demand and a shortage of housing inventory, are all contributing to the affordability crisis that low-wage workers all across the country are facing. Jordan Moreno, spokesperson for Homeward Bound, told in an interview with ABC 15, saying, "We see families coming through our door with $17, $18, $19 an hour that still aren't able to afford rent outside of Homeward Bound." Moreno stated that before the health crisis struck, success used to mean that at the end of their year-long program, participants would have managed to save enough money for a down payment on a home. And now, that's just not the reality anymore. Now we're seeing families go into renting an apartment, and that is considered success. If they have enough money to put down a deposit in the first few months of rent, and to be able to be sustainable with that, Moreno said. Similarly, Sherry Bushi, Phoenix Affordable Housing Program Manager, also revealed in an interview with ABC 15 that many renters and owners are spending a lot more than they can actually afford on housing. 50% of our renters are cost-burdened, Bushi affirmed, and 20% of our owner-occupied folks that actually own their home are cost-burdened by their home. Owners and renters who spend over 30% of their monthly income on housing and utilities are classified as cost-burdened, since they have less money left for other necessities and won't be able to handle unexpected costs. If you have an emergency come up, or a medical emergency, or you lose your job, you really have a hard time being able to pay for that housing cost, Bushi said, pointing out that in some cases, more than 50% of households were paying 30% or more of their income on housing costs, while less than 29% of renting households were housing cost-burdened in the North. The massive gap between wages and housing prices is the reason why millions of families are evicted every year, ending up in shelters or on the streets, and oftentimes being pushed to a poverty spiral that's incredibly hard to recover from. People in middle and lower income segments are increasingly priced out of the market for home ownership, and the situation will likely get worse as legislators are considering a number of bills this session that will significantly increase the cost of new homes. That's according to Tracy Doriot, 2021 president of the Tumwater-based Building Industry Association of Washington. Many of the bills have worthy goals. However, they also have significant consequences, Doriot said. In Washington state, every $1,000 increase in the cost of building a new home price pushes more than 2,500 people out of the market. We're asking legislators to also consider the effects that their policies have on preventing more and more people from attaining the American dream of home ownership, Doriot stressed in a news release. The National Association of Home Builders recently released a report pointing out home ownership as the main driver of household wealth. Across all racial and ethnic demographics, people's homes were their largest asset. The national group also published its 2021 Priced Out Estimates, which highlighted how higher home prices and rising interest rates affect people's ability to buy new homes. For example, in Washington state, the average home price is $522,023, but buyers need a minimum income of $112,295 just to qualify for a mortgage, which means over 72% of Washington's almost 3 million households are priced out. And for every $1,000 in extra costs, 2,524 more households can't qualify for a new mortgage. Doriot says by adding more and more regulation, legislators, sadly, are telling those in the disadvantaged lower and middle economic classes that they will not be able to own a home. With the passing of a new fiscal relief package, although payments may help to ease the economic struggles of renters and landlords in the short term, it also means our money supply will increase by $1.9 trillion. As soon as the economy reopens and consumer spending resumes to pre-lockdown levels, we will see a major spike in inflation, which is the most frequently mentioned trigger to the burst of the current asset bubbles. In that way, a dramatic housing market crash is now more imminent than ever, and that will cause enormous financial pain to homeowners as they see the value of their properties sharply collapsing. The Fed, then, will be forced to push interest rates up, not only jeopardizing the growth of the entire market for years, but also aggravating the affordability crisis and possibly contributing to the worsening of homelessness crises across the nation. As our leaders and policymakers seem to remain unbothered in the face of so many warnings, eventually we will all be witnessing an astronomical explosion occur across financial markets. Needless to say, we will be the ones paying the price for this tragic crisis made by design.